Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. The auto market has been absolutely crazy the last few years. Used car prices have gone through the roof. New cars are simply not available in a lot of markets, and a lot of automakers simply aren't making cars because it's more profitable to make trucks and SUVs. So this isn't going to last forever, and eventually this bubble is going to burst. I think we may already be seeing signs of that. And there's a couple of companies that are leading the way. One is actually Tesla, who recently reduced the prices of their vehicles all over the world. That caused a crash in used car prices for Tesla vehicles. And there are some big companies in the used car market that are impacted, like CarMax and Carvana. So I want to go through some of this data and show exactly what this is going to mean to companies, investors, and potentially the overall economy over the next year. I'm Travis Hoium. Thanks for watching Riiv Investing. Please subscribe to this channel, give this video a like, and share it with anybody you think would be interested. I want to start by laying the groundwork of where we are in the vehicle market. This is the Manheim Used Vehicle Index produced by Cox Automotive and Manheim. You can see that since 2020, the index itself has jumped over 100 points, which indicates that used vehicle prices are absolutely through the roof. If you've looked for a used vehicle in the last couple of years, you would have noticed this. There's a lot of times where used vehicles are actually selling for more than new vehicles. That's very unusual. But you can see here that over the last few months, prices have started to come down. There have been a couple of shocks to the market coming specifically from Tesla, who is actually one of the automakers that has had an abundance of supply because they use their chips a little bit differently than some of the traditional automakers like Ford and GM. So they've actually been growing production as a lot of these other automakers have reduced production during the pandemic. But now those legacy automakers are increasing production. Potentially demand is going down as interest rates rise and the economy slows. There's less stimulus funding, and that means less demand for vehicles. Tesla actually had some discounts late in 2022 and then had a big reduction in prices in January by as much as 20% off the sticker price. That caused companies like CarMax to actually try to dump their vehicles. You can see in this tweet here that in a matter of about 24 hours, CarMax sold about half of the Tesla vehicles that it had. It did that by reducing prices by $10,000 or more in some cases. This is going to have a downstream effect on a number of companies, CarMax included, but think about Carvana is another company, has not done the same level of discounting, but now those vehicles that they're holding in inventory are actually worth significantly less. So eventually they're going to have to reduce prices and take those losses. And remember that Tesla actually has its own used car business. Right now, Tesla actually has more inventory of Teslas than CarMax does. We likely won't see those losses hit the income statement for the fourth quarter of 2022, which will be reported in the next couple of weeks. But that will be an impact on income in Q1 2023. There are also starting to be reports that delinquencies are starting to go up on some of these used vehicles. Now remember, if you buy a used vehicle at an elevated price, the value comes down and potentially buyers aren't willing to pay for the vehicle that they bought. So they're just going to default on that loan and then that vehicle has to be repossessed. That's not great for the economy and especially for lenders. You can see here data from the Federal Reserve, and delinquency rates are on the rise. This data only goes through Q3 2022, so investors will want to keep an eye on what these delinquency rates for consumer loans look like in Q4 and into 2023. Now, taking a step back, it is worth pointing out that delinquencies were at a historic low early in the pandemic. That is because people had plenty of money, plenty of savings because of stimulus funding and money that they weren't spending on going out and doing things in the economy the way that they normally would. So this is a little bit of a returning to normal, but we don't know exactly what normal is yet. This report from Cox Automotive also highlights these same trends. Used vehicle sales are falling month over month in December. Auto loan performance is deteriorating and defaults are up from a year ago. So this is not great for the vehicle market right now, particularly the used car market. And if used car prices are going to come down, that means that new car prices likely need to come down as well. What I'm looking for over the next couple of quarters is Tesla is really going to be the canary in the coal mine here. Do margins come down as prices are coming down? What happens to volume? Are they able to keep that production growth up and put pressure on legacy automakers? And then on the same token, companies like GM and Ford are they able to increase their production and maintain reasonably good margins that they had during the pandemic? Or are they going to be impacted by companies like Tesla cutting prices and the value of used vehicles coming down? Right now, I don't think we see a lot of discounting from these legacy automakers, but Tesla is definitely cutting prices, trying to put pressure on their competition. This is something that we're going to need to watch very closely over the next few quarters because it not only impacts automotive stocks. CarMax is definitely going to feel the pressure. Carvana is a stock that I simply wouldn't touch right now because it does not have a sustainable business model, and we likely have more losses coming from the Teslas that it's holding in inventory. But there's a lot of pieces at play. I wouldn't come to too many conclusions too quickly until we get fourth quarter numbers and then likely numbers for the first and second quarter of 2023 too. We're still coming out of this pandemic situation where we had abnormal pricing, abnormal margins. We're going back to more of a normal level. We just don't know quite what normal is yet. I'll be covering the auto business, particularly some of the high growth automakers here on Riiv Investing. So thanks for watching, and I'll see you here next time.